Good evening, everyone. Time for another silver update. This is the weekly chart with the MACD drawn on it. There's a couple of trend lines here. You can see the new low that we've hit on the weekly MACD is roughly 0.72, which is the lowest point we've hit barring the bottom that we had back in 2008. This chart goes all the way back to 1995. So we may get a lower low than 2008. I seriously doubt that. It looks like we're probably going to get a bounce soon, although you can see the distance between these two lines is still one of the greatest distances that we've ever seen on this chart. So the rate of decline is still very steep, but if you look at the slope of this line, which is the price trend, which is still intact, and I'm going to revisit this line when we look at the latest Jim Willie article, but you can see that this slope of the price line is much steeper than the slope of the MACD line. That is assuming that we have made a bottom in the MACD. So that's a very encouraging sign. The other encouraging sign is the length of this spike. And this is unprecedented. If the percentage move off of this spike bottom is commensurate with the previous moves, such as you can see, this spike move here was roughly from about, we'll just say $12.50 down to about, we'll just say $11. So this is a $1.50 spike roughly, even though it wasn't even that big, but we'll just say that for the sake of argument. So this move here ended up going from about $11 to 22 on the high end. We'll say 22. So that's an $11 move on a $1.50 spike. So we'll just say tenfold just to be a rough estimate. And if we draw this same spike here, we'll want to draw it from about 26, say, and then maybe 31 or 32. We'll be conservative and say 31. So we'll do $5 on this one. If we get a tenfold move on this spike, then that would project a price of, from the bottom, would be a tenfold move of this spike is $50 plus the 26 that we're at. So that's projecting a price of $77 if we get the same type of move based on the spike that we had. And that's just comparing the spikes back here and some other spikes. This is really an outlier as far as the size of this. So obviously we've moved into new territory, and if we turn around and go up, I think we're going to move dramatically higher. The daily chart is still just kind of dragging along. We've managed to maintain the low of 26, and we had a revisit down to about 28, and now we're just staying roughly in the low 30s. The daily MACD has crossed over, and you can see that it's moving higher, although it is still starting to roll over on the 8-hour chart. So we're kind of at a decision point here. Will we get a rollover and down, or will we get something like this, which is a consolidation? My guess is more likely a consolidation or a move up than a move down, and it's starting to look like that. It's almost starting to look like it's ready to bounce up again here, but we'll have to wait and see. I want to jump over to that Jim Willie article real quick. He projects I'm not going to cover the entire article because it's a lot about the euro and gold and other things. I just wanted to talk about the metals here. But he talks about silver and gold, and he calls it an engineered decline. Engineered gold decline halted. We'll zoom in a little bit. This article would be remiss not to point out that history is being made. the COMEX has decided to raise margin requirements while a falling price is occurring for both gold and silver. Now, if you'll note, we've pointed out before, the margin requirements for silver are actually much higher than gold. You're talking roughly 16% of the contract. At one point it was as high as 20% of the contract. Normal margins for all commodities are around 5 and 6%. So silver at one point was 4 times the margin of other commodities, and now is sitting at roughly 3 times the margin for normal commodities. And they haven't lowered the margins even though the price has fallen dramatically. So very important point there. Normally the opposite is the case. Notice no U.S. T-bond margin hikes, even though an asset bubble. If truth be known, the damage done to the Paulson Fund had a big hand in knocking down gold. Motive is painted on the walls. Policy is to tarnish the precious metals as the global monetary system continues to crumble. And I absolutely agree with that. The purpose, of course, is to chase people out of the precious metals because that's the ultimate safety. Of course, physical precious metals is the ultimate safety, but they used a paper attack to try to discourage and wear down the precious metal investors. Of course, the stackers just looked at it as an opportunity to keep stacking. So I hope that all of you are still doing that. As the U.S. government deficits head towards $2 trillion annually and the U.S. economy enters a recognized recession along with Western Europe before renewed stimulus is attempted. And I agree with him there. This is, again, another deflation scare that they're rolling out to give them cover to print a whole bunch of money, because that's the only thing that central bankers know how to do, is print money. With all the destinations staring the bankers and politicians in the face, they wanted the gold and silver prices to be pushed down. The next upsurge will be one for the history books. With new money heading to fill holes in bank bond bailouts, the recapitalization of numerous banks, the economic stimulus, and the government debt monetization led by the U.S., the debasement of major currencies will be astounding. The gold and silver prices will make strong new highs repeatedly. And this is a gold chart. I think the more interesting one is a silver chart, although he's showing a bullish crossover here. The silver price is ready to bust north too, but in a more emphatic display. Its decline was led by the gold decline, but was also pushed by the industrial demand card from a slower economy. The extreme silver supply deficit has not gone away. Neither has the huge silver coin demand from various mints around the world shown any sign of relenting. The silver price has a MACD reversal in progress. That's this one right here. And the 30 breakout level from the final months of 2010 has been defended. The potential for a powerful reversal to fill the obvious gap from 32 to 40 is painted loudly for all technical traders to see. No resistance is presented. A pit stop at 36 will come, enough for a cup of coffee. And he talks about Operation Twist and how it was really just a cover for the Fed to buy out a bunch of treasuries from Europe. And he conclude global QE is here in earnest, uniformly and powerfully so. If all central bank outpost nodes participate, the US dollar will not fall much, if at all. The central bankers are willing to wreck the global economy in order to contain the cost structure from demand destruction, a truly dangerous ploy since they risk toppling their own subservient, collusive big banks. And he goes on. So, very good article. Encourage you to read that. Now, he did mention the bond bubble, as he says, and I want to give you a chart here that I pulled up. This is from More Research. This is the 10-year note, and this is the price of the 10-year note. You can see, now, bonds don't rise like other things. They're limited in price because it's a inverse relationship to the interest rate, so they can only go so high and so low. But you can see here in the 10-year note that we have a rally that began in 1982, actually a little bit before, but we'll just say 1982, and we're coming up on 2012. So we're looking at a 30-year rally in government debt. This is the biggest bubble in the history of the world, right here. a 30-year bubble in government debt. So when people talk about gold is in a bubble, silver's in a bubble, nothing of the kind. This is the bubble, government debt. And of course, this government debt is either going to be defaulted on or it's going to be inflated away. There's no other choice, because the governments of the world have promised more than they can deliver, and they are in the process of collapsing right now. So as I've warned many times before, I have to warn you again, with all the Occupy Wall Street things going on and all these other crazy things going on with state governments and the federal government and everything else, that these promises are going to collapse, and that if you're counting on government income, whether it is a government job, whether it's assistance, excuse me, whether it's welfare, food stamps, Section 8 housing, anything, it doesn't really matter. I'm not making a moral judgment. If you are expecting money from the government to support you, SSI, disability, you better plan on something else, because it's either going to be cut drastically or it's going to be inflated away. That's just a matter of fact. The money has already been spent. It's lost. It's gone. There are more people now riding in the cart than people are pulling, and people are quickly stopping pulling the cart and jumping in the cart, and everyone's going for a ride, and it's a ride to complete collapse. So we're on the way. There's no stopping it, and we appear to be taking a turn down back into recession. Now, I wanted to document that. It's very interesting. I often check these charts here. If you go to Kitco Metals, there's a page that covers the LME base metals, and I watch these fairly closely because they're a good indicator of where things are going. Now you can see the copper price. You can go over here to the 5-year copper, and you can see we're nowhere near the price that we hit at the bottom of the 2008 deflation scare that we had. But we are falling fairly sharply. Now, the thing that is interesting is that I always watch the copper stocks. You can see we have some 30-day and 60-day warehouse stocks, and you used to be able to go and look and see the nickel default and all these things on here. Unfortunately, for the last couple of weeks, Kitco's or the LME or whoever it is, all of their stocks are broken. So you can no longer view any stocks in lead. You can see there's no price listed there. You can't see them in nickel. You can't see them in zinc. They're just not available. Kind of strange, kind of suspicious. My guess is that these stocks are simply going through the roof. The last time I viewed them, they were at all-time highs, which is portending a dramatic drop for the price of all of these base metals. Here's lead. Most of these are dropping. Now, a lot of people would say, well, that's forecasting a depression or a tremendously deep recession. And I would agree, it does. If these base metals warehouse stocks go absolutely through the roof, which means that no one is buying them, no one's using them, no one's building anymore, obviously the prices are going to have to fall off a cliff. And people would ask, well, what is the impact for silver on that? And actually, as I covered my last episode about this issue of how silver is mined, believe it or not, to have these stocks explode in number and to have that portend for a tremendous price drop in the base metals actually is tremendously bullish for silver. And that's because silver is a byproduct of these base metals, copper, lead, nickel, zinc, and it's found when they're mining for these other things. If the stocks are going through the roof, the price is falling, there's very, very little incentive to continue to mine these things, and it's time to wrap up operations, slow them down, because it's becoming less and less profitable. So what that means is that less and less silver will be coming, and we may hit that peak silver due to the fact that the mining has to wind down. There's no point in mining something at a loss. So as a consequence of the mining winding down, less and less silver will be mined, and we may see that peak silver number around 700 or 800 million ounces and then turn and go down from there. So very, very interesting. We're continuing to rise, and I have no reason to believe that we are not going to bounce. I still project a tremendous bounce off of this line and off of this spike. I have projected $100 by the end of the year. I'm going to stick by that projection, although it's looking a little bit crazy, but we'll look and see how big of a bounce we get when we finally do get the bounce. I may have to revise that projection. At this point in time, I'm not. I'm just recommending that people continue to stack silver because it's really the only safe way to save money at this point is stacking physical silver. And we'll talk to you next time.